Thanks, Diane. I had some fears of standing up here that my head would rub on the roof, but I think I'll be okay up here. I usually tend to walk around and flail my arms when I speak. I guess this whole gathering was Mark's brainchild, and he said, I want to do something for my customers. I want to do something special. I want to do something where we're not just presenting products and talking about ourselves, but where we're solving real-world problems, real-world situation. And he did an amazing job of creating a company that just raises so many of the issues that we deal with at EDC on a day-to-day basis. And as I read through the case and read through the company's situation, I guess there were a number of issues that came to mind from an EDC perspective. Just dive right into them. I guess when I first hear that a company is looking at setting up shop or has operations in South America and some of the places in Eastern Europe, and I'm thinking about the CIS, the first thing that perks my ears is political risk insurance. And depending on the location in South America, and even depending on the location in some of the European offices, we might want to talk about the real risk of expropriation of some of the assets, depending on where you are in South America, or even potential risk of having bank accounts frozen, depending on the political climate in some of the places that you're worrying about. And I know a lot of companies don't really take it as a real concern, but I always think back to Iceland a couple years ago, where you may have been doing business in Iceland, had been attracted to that market because of what was going on there in the financial markets, and all of a sudden we're stuck with a currency that was no longer convertible. And as we continue to read the news, that's becoming, I think, more and more of a real issue as we look at some of those, Greece, for instance. And I think we call them, those countries, the pigs. And there's some talk, at least at my end, about future currency conversion issues. So political risk insurance is one of the things that I would want to explore with CanTrade, and talk about some of the markets that they're operating in the country risk. I'm also going to assume that CanTrade, our company here, is generating a lot of receivables from foreign countries. And the thing about generating receivables from other countries, I guess if you have a normalized banking relationship and you have an operating line of credit, most banks are happy to margin your Canadian receivables. They'll probably give you 75%. They're pretty comfortable margining US receivables, and they'll probably give you anywhere between 50 and 75%. But if you're generating receivables really outside the North American continent, the bank is not going to give you any value for those. And when we talk to companies about insuring their receivables, I'm going to say 50% of them come to us because they have margining issues at the bank. The other 50% come to us because they're generating receivables in part of the world where they're really uncertain about the collectivity of them. And I guess a write-off in some of these parts of the world would be a catastrophic loss. Doing the credit adjudication on some of these accounts can be quite difficult. You're dealing in places where it's really hard to get credit reports, credit information. You might get information that's not even in a language that you understand. And I always make the joke about having a customer dealing in Brazil, and I got some information and sent it off to one of our departments that does translation. And I said, I need these translated from Spanish. And somebody called me a bonehead and said, they don't speak Spanish in Brazil, it's Portuguese. So I had a sense of what some of my customers go through. The other thing about talking about accounts receivable insurance, it's a risk mitigation tool, it's a financing tool, but it's also a real sales tool. We have a lot of customers who really leverage their accounts receivable insurance policy, and they'll get endorsements that are called extended payment terms endorsements. And what a lot of companies are doing, proactive companies, is they're taking their accounts receivable insurance policy to countries where credit is really hard to come by, and they're providing customers with extended terms. So not only giving them 90 days of credit, but they're offering them 180 and 360 days of credit. And this is pretty popular in places like Russia and the CIS, where dealer financing really no longer exists and operating lines of credit are really hard to come by. And it really offers a financing mechanism for companies that manufacture agricultural machinery to get their equipment into those markets. Sometimes I'm the creator of my own problem, and if we're talking about providing customers all over the world extended terms and using accounts receivable insurance, you can really strap yourself on your bank line. You could end up, if you're carrying a bunch of customers on your own operating line, you could run out of operating line pretty quick. And if that happens, we're always prepared to assist at this end as well. EDC gets involved quite a bit in working with the bank and providing what's called an export guarantee program. I promised myself I wasn't going to use any EDC jargon, but we can provide a guarantee to the bank, which is basically a credit enhancement, and allows the bank to extend additional credit to finance those extra receivables that you're carrying. And by the way, they're insured. So, really, if we're offering the credit enhancement and we're insuring the receivable at the other end, the bank is typically pretty motivated. They get to collect the interest on the whole line anyways. So. Any bankers in the room? Good. Just I'm a recovering banker too. Don't be embarrassed. The other issue I spot right here right away is the company has inventory that potentially could be located offshore. And again, that poses real difficulty for your bank. They're comfortable margining inventory that they can go down and see and feel and touch and count. But if your inventory is outside the country, again, the bank is not going to be all that receptive to providing you margin value with that. And once again, this is where EDC would work with the bank to provide a credit enhancement in exchange for providing some margin value on inventory. At my end, it's become very popular in the apparel industry. I guess Winnipeg used to have a very big schmada industry or apparel industry. Most of the offices are still here, but most of the manufacturing is offshore. Ergo, your inventory is offshore, and if you're shipping into North America, you may not even be shipping into Winnipeg. And that's where some of our guarantee programs come into play. I see here CanTrade is also sourcing a lot of their inputs outside the country, and I think our experience is Canadian suppliers or North American suppliers operate on North American type trade terms, which means they usually give each other credit. 30 days is quite common. But if you're ordering stuff from outside the country, suppliers tend to be a little more conservative, and they want to get paid by letter of credit, or they want to get paid basically cash on delivery. And if you have inputs that go into a manufacturing process, they tend to be a drag on cash flow as well. You have to buy your inputs on cash, and it may be 60, 90 days before you can convert it into a product, and another 60, 90 days before you can sell it and collect the receivable. And so what we've been doing is we have been using the bank. We provide a guarantee to the bank, who in turn issues a standby letter of credit or bank guarantee to a supplier. And so if you have the ability to go to a supplier with a bank guarantee in hand, you can not only possibly negotiate better pricing terms, but you can also negotiate some payment terms. So in exchange for your engine supplier giving you 90-day terms, you might secure him with a standby letter of credit, and he'd give you 90 days of payment terms and perhaps give you a better price, because all of a sudden there's really no risk to the company in offering you any credit. And by the way, if your supplier is smart, they'll take that standby letter of credit and they'll margin it on their operating line. It's kind of the concept of supply chain financing. See here that CanTrade has raised the issue of potentially doing some more expansion outside the country. They would appear to have some manufacturing assets or some offices outside the country. I'm just going to mention that EDC is more than comfortable financing assets outside the country. We typically don't like to do financing inside of Canada. We don't want to be competing with any of our sister corporations. We don't want to be competing with the banks. But we are more than comfortable in financing assets in the US, in Asia, in Europe, where your bank may not be comfortable having a mortgage on a facility in Leningrad. I don't know. We've been doing some of that actually in Asia lately. And the last thing I would throw out is EDC is very active in what's called the buyer finance market. I spend a lot of my time doing this, and I would mention this to CanTrade as well. If you run into a customer who is eager to buy your product, but has some financing issues of their own, EDC is receptive to meeting with your buyers and potentially providing financing to finance not only the purchase of your goods, but other Canadian goods and services as well. We recently did a transaction with Inco, which is which has, I guess, generated some business in Manitoba. Not only, I guess, with the purchase of mining drills, but other inputs as well. And we also have some lines of credit actually set up with customers in the CIS who use a line of credit to purchase all sorts of Canadian agricultural equipment, and that works quite well as well. So thank you for your time. If you have any questions, I'll be around and we can chat.